Welcome, everybody, to Crossing the Line, where we're always digging into the latest news on the economy, housing, and anything else that catches our eye. Today is a snowy/rainy day here in New York City. It's January 16th, and this is our 9th episode, Hannah. We just keep surprising ourselves.
We do.
Special welcome to any new listeners out there. Please make sure to subscribe to this and all the other great podcasts on the More Network. I'm Greg Heym, Chief Economist at Brown Harris Stevens, and what passes for a podcast host these days, and author of The Line, a weekly blog on economics, joined as always by my co-pilot Hannah and Ray and Lena behind the scenes. But today we have a special guest, and we like having guests. We have the great Ari Harkov, broker extraordinaire. Welcome to the program.
Thanks for having me. Pleasure to be here.
How are you doing today with this crazy weather and everything?
Yeah, could be better, but it's calming down a little bit. Not too bad.
Well, you know, we do what we can when we have guests, but we can't control everything. We control the weather in here, I think.
Yeah.
Hopefully that we can do that. Again, always at Studio 1873, also known as the Vince Rocco Studios, and always trying to be informative, concise, entertaining, and edgy. And again, your feedback, please send any comments you have to ctl@bhsusa.com. Well, let's get right to our line items. And again, those are the headlines in the blog that went out on Friday. So what do we got first, Hannah?
Well, inflation. It was higher than expected in December. Do you want to get into that a little bit?
Yeah, actually, both the line items had something to do with inflating things.
Yes.
One prices, the other one budgets. So, you know, it's the week of the PI brothers, you know, Consumer Price Index and Producer Price Index, which is the CPI's baby brother that people don't really pay attention to. Their much cooler cousin, the core PCE, comes out at the end of the month. So that kind of trumps everything. So let's enjoy the PI brothers while there's still news. And, you know, Ari, the scariest words in economics these days are higher than expected, right? Mm-hmm. We don't want to hear jobs, you know, hiring going higher than expected, and we don't want prices higher than expected. And, you know, we saw that with CPI, but it's not as bad as it seems. Prices up 0.3% last month and 3.4% from a year ago. Those are the headline numbers. But what we're really looking for is core CPI. That excludes food and energy prices. The reason is that those are very volatile. They can change. Usually, core tends to run lower than the headline number, but that's not the case now because energy prices have come down significantly.
Correct.
And, you know, on a cold, miserable day like today, it's good to have lower heating oil and gas prices, right? That certainly helps out. But that came in, core CPI, at 3.9% over the past year, and that was also a little higher than expected. The main driver of inflation, well, it's kind of the real reason we're here, which accounts for more than half of the increase in CPI last month, and that is shelter, or as we call it, housing. Shelter sounds really old. And they're up 6.2% over the past year. And we've kind of seen the national numbers, right? The prices just continue to go up, although the shelter component is based on rents. And does that make sense to you as a broker?
Well, I mean, shelter from an inflation perspective is a mix of rents and then the homeowner's equivalent of rent. So, you know, what they would otherwise be paying if they were, you know, renting a home. Does it make sense? I don't know. I mean, it's a way of kind of normalizing the data, so to speak. So I think, you know, in that respect, it makes sense since you've got roughly a third of the country that rents and roughly 2/3 that own. But clearly, you know, the inflationary environment in shelter is a big driver for where we are from an inflation perspective. And as you said, and as we talked about before, you know, we're in the period, I'm going to mix the two up, disinflation and deflation. So, you know, we're in a period.
We're going to have a whole segment on this.
Yeah, we'll do the whole piece.
Please
so I'm going to hold that.
But
the idea is basically that the rate of growth from a housing price perspective has declined, but the growth is still there. And that's the key.
Well, I think, too, one of the arguments I've heard that makes me lean towards using the rental or the owner's equivalent rent is if I bought my house for $500,000 and it's worth $1 million now, that doesn't change what my monthly payment is in and of itself. So we really want to track the cost of shelter. We should ignore any unrealized capital gains,
Correct.
I guess would be the
Yeah,
best.
it's not impacting your day-to-day carry as a consumer.
Exactly. And so Baby Brother producer price index actually fell last month a little unexpectedly. So just to make things interesting, CNBC does a nice little chart of what went up the most and what went down the most, or prices went. So if you want to know what not to buy right now, frozen non-carbonated juices and drinks up 19%
bummer.
over the past year. Uncooked beef steaks.
That was on top of my list.
You know, I always tell my wife, go to the meat store and get steaks. It'll be cheaper if we cook them at home, but apparently not, because it's 11% more than it was. Here's one that got me. Motor vehicle insurance. I got a renewal last month that made my eyes pop out of my, and I switched insurance companies immediately. And then 4 days later, my wife got sideswiped by somebody.
Oh, man.
It was unbelievable. The timing was terrible. And tickets to sporting events up 15%.
That affects you personally.
Are my teams playing 15% better than they were?
That's a good question.
Right.
Money's worth.
Yeah, really.
You know, I've been to one Ranger game this year and they lost. I'm jinxing everything. So those are some of the bigger veterinarian services for you animal lovers out there. Sorry that's gone up. If we look at what went down in price, eggs, 24%. Now, it's been one of the things that really has gone up the most. But the problem is, they always say, eat eggs, don't eat eggs, have egg whites. It doesn't matter. You might as well eat the whole thing.
Who says that, doctors?
They.
They.
There used to be a Far Side cartoon where there's a guy sitting at a desk and the nameplate said they.
Yeah.
And I'm like, so you're the they.
Yeah.
How do you feel about eggs, Ari? You have an opinion on them?
I don't eat eggs.
Okay, well, see, there it goes. Yeah. Fuel oil down 15%. Really good news. It's funny, I have a brother who lives in Dallas, and he went to the game, unfortunately, watched Cowboys get really beaten bad by the Packers. But the interesting thing, it was at 15 degrees.
In Dallas.
And somebody posted on TikTok a video of all the people running into the arena because they were so cold. And then, of course, by halftime, when they were really getting beat bad, someone reversed it and said, oh, look what happened in halftime, and they're all leaving. Here's one that went down that doesn't seem like it went down. Health insurance over the past year down 27%. Surprising to me. But, you know, I'm not going to complain that health insurance went down. Although we locked in our insurance, I think, in November. But that doesn't matter. I'm healthy.
I think you're right. Yeah.
Yeah.
So it's fine. So getting back to the inflation thing, it wasn't a terrible report. One of the things that markets really look at is the monthly change in core CPI. And that came in as expected, 0.3%. And again, the thing with core inflation is it takes longer to come down, right? Because energy prices, we see how fast.
Correct.
But housing prices don't come down
It's
quickly.
a super tanker. Takes a long time.
Unless there's a pandemic or even then. But Lehman Brothers was an example of how prices can drop 25% in a couple of months. But remember here, the Fed's done hiking rates. They've said that, pretty much done everything but gotten the Goodyear blimp. We still have the Goodyear blimp? I don't know. To say
Let's hope.
But we can't say that inflation is not a problem anymore, right? Because the Fed's goal is 2%. We're looking at 1.5% to 2%, depending on which index you're looking at.
Sure.
We found out that the companies are still hiring like gangbusters. The unemployment rate is still below 4%. And wages are rising at a 4.1% rate. So when wages are rising 1% more than prices, basically, that can lead to more. We say this, how many people are hired in a month is important, but wages are more important for inflation because everybody who's working is getting paid. That's a lot more people than the 200,000 people that may be hired.
Correct.
And, again, inflation has come down significantly. In the 12 months ending December 22, the rate was 6.4%. So the fact that we're about half that is good. But a lot of people were betting on rate cuts starting in March, right? And that's not going to happen.
No, that's off the table at this point, I think.
Was I the only one who thought that was ridiculous?
That makes no sense.
I'm saying second half of the year. What do you think?
No, I think that makes sense. I mean, inflation, if you use your numbers, if we're 1.5 to 2% above where the target inflation is, we're 75 to 100% above where we need to be. Those are big numbers. So, people look at like 0.3, 0.2 as kind of like, small numbers, but they're actually very significant from a percentage perspective. So I don't think the Fed's cutting rates for at least another quarter or two if we're lucky, unless we see new labor data that, suggests otherwise.
It would be irresponsible, and I always use the termites in the house thing. I've used it too much. You got to get all the termites, or your house is still in jeopardy, or you got to take all your antibiotics, or that infection's coming back.
That's your personal favorite.
Well, because I'm one of those guys. If antibiotics can bother my stomach, it's like I feel better.
You got to keep taking the amoxicillin.
At least it's cheap. It's one of the cheaper medicines. They
rips
give it
up
to you
your
for
stomach
free.
though. So
It's awful.
Awful.
All right. So the second item is also about inflation of a certain type.
Yes. The budget deficit of a hefty $510 billion.
In just 3 months.
Yeah.
So the headline was $510 billion in just 3 months. And then I said, no, that's not what Shohei Ohtani is going to earn this year.
Yes, that did get a chuckle out of me.
It's the first 3 months. Remember, the federal government's fiscal year starts October 1st. So it's bad enough we don't have a budget. We found out today that they may have an agreement on another continuing resolution, which is basically kicking the can a little further down the road. But running up $510 billion in debt, I mean, that sounds like a lot, and it is a lot, but it also brought our total debt over $34 trillion.
For the first time.
Yeah. Should we be scared about that?
When you have a rising deficit in a rising interest rate environment, that's not a good combination.
And to your point exactly, last year, the federal government paid almost $660 billion in interest. So you add debt at higher rates, and you think our credit card debt at $1 trillion is a problem. Not me and Ari's.
Yeah.
He may be able
Mine's
to.
a little bit lower than yours.
Yeah, well, I owe.
You bought that nice snowblower for this.
What's that?
He used it this morning.
Yeah, he did.
What's that Springsteen line? I have debts no honest man can pay.
Yes. What a poet.
He does all right. I got to represent Jersey because I'm not going to.
Thank you.
I'm not going to talk good about Bon Jovi. That's not happening. Again, this isn't a political statement. I'm really. Both parties spend the money, and I don't want to scare people because I think we're going to pay our bills. We're still the world's reserve currency, right?
At least as of this morning, I think. Yeah.
Yeah. Well, we'll get back to. I mean,
the yen's nipping at our heels, though.
As an economist, the concern we have is that you're taking investment away from the private sector, which tends to use the money a little more wisely than how the government spends it. But, I mean, to put it in perspective, in the 60s, non-defense spending was about 10% of GDP. It peaked at 28% during COVID, understandably. We're looking at about 22% for the next couple of years. And again, we still don't have a budget. So get it together, Washington. You're getting paid a lot of money to find compromise and fund the government. So let's get it done. All right, so those are the line items, and we did pretty good on time. So that's good. So now we have Hannah's favorite segment, the lineup.
Of course, it's my favorite.
Copyright Hannah Enterprises.
Yeah, wow. That's a new title there, and it's bold, and I love it.
We name everything around here.
Yeah. Well, I wanted to talk about the current state of housing affordability, if you wanted to get into that.
Yeah, well, we want to talk about it now because it's getting better.
Right.
So you remember a couple weeks ago, we had that article about how the math of homeownership doesn't work for a lot of Americans. A combination of rising prices, rising rates, has made it out of the reach. And then there was this article about Gen Zers, almost a third of them living with their parents still. And I'll be the first to admit, when I was in my mid-20s, I was living with my parents too. I mean, I was saving for a wedding, but, it wasn't that affordable for me to get my own place in Long Island and save for the things that I wanted to do. But
I am not in that 31%.
I wasn't going to mention that, but now
but
that you brought it up, she's our official Gen Zer.
There you go.
Okay, thank you.
I'm the official Gen Xer.
I'm here to represent New Jersey and Gen Z. It's a lot of pressure, but
I think if anybody can handle it, you were willing to take on Wall Street last week, so I don't think you're too worried about it. All right, so we hit a 23-year high in mortgage rates at the end of October. Since then, rates are down 1%. People are more optimistic about the future. Freddie Mac says a survey they do every month, And that's showing that people are a lot more optimistic about their ability to buy a home. And it says here, last month, a survey high of 31% of consumers indicated they expect mortgage rates to go down. So that's a good sign. That doesn't necessarily mean they should wait to buy. But so we see it in the stats. Rates are down. Mortgage activity hasn't shown a huge jump yet, but that's going to take some. So what are you seeing out in the field, so to speak?
So, yeah, there's a lot to unpack. I mean, so the first thing is, as you said, rates are down, over 100 basis points, but they've essentially plateaued for the last month or so, and there have been movements where they've actually gone up even a little bit, and then I think in recent days gone down a little bit. I sort of track it on a daily basis. So, the big bump that we got, so to speak, happened, a month or so ago, and we're not seeing further declines because we're not at a point where, the 10-year Treasury yield is falling as of now.
Well, what's narrowing there is,
the spread.
It used to spread between the 10-year and the 30.
Right. So the spread is narrowing. The 10-year came down a little bit, and so rates came down, a meaningful amount and increased affordability. But I don't think we've gotten to that magic level where you're seeing a significant increase in terms of buyers entering the marketplace. My personal take is when you start to see rates across the board consistently in the fives, that's when you're going to be at a point where you start to see maybe not a flood, but a very significant increase of the number of buyers.
So we had done a piece a couple of months ago. There was a survey asking potential home buyers how low would the rate have to get before you jumped in, and the average was 5.5%.
Yeah, I think it's right in the fives.
Because
that's what people say.
they claim, the respondents, that that's what mortgage rates typically average. I mean, that's not true. They average about 7.8%.
But psychologically, that's what they think.
It's like, so do you think they're seeing such a rapid decline after such a rapid increase? Are they waiting because they just said, you know what? Yeah, it's sitting a little above 6.5 now or whatever. I'll wait. It'll be 6% by next month, and then I'll make my move.
I think the rate equation is there's the psychological, emotional component of just, do I feel good about taking this rate? Did my neighbor do better than me? Does this feel right to me? Which is not at all mathematical or arithmetic in any way. Then there's the kind of the affordability piece of, at 6.5, I can afford less than I can afford at 5.5. It's just simple math. And then the last piece, which is probably the biggest driver of the U.S. housing market, is you're looking at the spread between where homeowners locked in 2021 and 2022 and where rates are today. And as that spread collapses, as it gets smaller, you're going to see more sellers entering the marketplace who will then also become buyers. The buyers are sellers and the sellers are buyers when you remove investors and first-time home buyers. So that spread, I think, is the big driver. Obviously, people are talking about it using different terminology. That's the idea. When you're locked in at 2.5 and rates are at 6.5, you can't stomach that 4-point spread.
And I think, the one thing that people have to remember, we're talking about that increasing inventory because those people that have been waiting to trade up or trade down will do so. But remember, it's almost a zero-sum game because they're going to buy
a new seller
something.
And a new buyer come into the market
so
at the same time.
It will impact certain segments. And
Correct.
The inventory is so low in so many parts of the country, right, that even if you're ready to go, it's going to take you some time to find.
Correct.
Yeah, it's pretty challenging out there, and it's all about individual locations and markets. Sure. It always is. And New York is sort of special in that way. And, I'll let you go into all the things that makes it different. But the number one thing I'll point out is, we measure inventory in terms of months supply.
Correct.
The inventory in Manhattan is about a 7-month supply on average. Now, that varies greatly between studio and one-bedrooms and 3+ bedroom super luxury condominiums, although they seem to be selling just fine. So we're sitting at 7 months. The U.S. is sitting at 3.5 months for existing home sales. And I think that really, for me, is the best way to define why we're in a different position. We actually have homes for sale.
Sure. So let's unpack that further. When you talk about months of supply, the months of supply is, I'm going to forget my, math class numerator denominator, but you're taking the rate of closings divided by the amount of inventory that you have, or vice versa.
The other way around.
Other way around. I can do math.
So if you have, I'm sure, but that's what they pay me.
So that's why I have the economist here. So if you take that equation, you look at it, it's a function of demand, what's the rate of closings, and then it's a function of supply, how much is on the market. So I would actually say say that 3.5 is painting even a rosier picture than what it really is for New York City, in the sense that our demand is weaker than other parts of the country because there's still work from home and people want to be in more suburban locations and what have you. And so our supply is actually sitting on the market a little bit longer. So I think it's a function of both is the answer. Whereas other pockets of the country, that are maybe coming down from their pandemic, Zoom city highs, are still faring better than they were in 2019 when people, had to be in an office 5 days a week.
And we talked about this when we were brainstorming for today's podcast, that prices here in New York City have not really moved.
They're flat.
So you have a pandemic and we can't even show apartments and homes for 3 months. Prices don't really go down. Mm-hmm. Then you have rates start to climb at a rate that they've never, Then we have activity like we've never seen in 21 in the first half of 22. Prices don't really move. Then rates hit a 23-year high and prices don't move.
Correct.
So they're never changing.
Correct.
I love when I'm asked to answer these questions because it's one of those humana moments. But I mean, there is, when there's a fundamental shift, something major happens, rates change, supply changes, pandemic hits, those things, this isn't the stock market. The thing doesn't reset like that. Stock prices can change in a wink of an eye because all the data just moves them.
Sure.
For us, it takes, and then before you even made the first adjustment, the second adjustment comes along, and then you're really messed up when a third adjustment comes. But what we've seen in the rest of the country is inventory get under 2 months, in some cases under 1 month, and prices are continuing to set records, and affordability is a much more serious problem outside of Manhattan, isn't it?
For sure, and outside of urban areas in general.
Right.
There's a lot to be said there, and also the numbers that you're giving, the nominal prices may not have really moved a lot in New York City in the last 3.5 years. But from an inflation-adjusted perspective, you could actually argue, I don't want to necessarily say this on the podcast, but prices are down. They're inflation-adjusted down because inflation has, obviously, as we've talked about, gone up considerably across the board. If you compare it to the equities markets, you compare it to owning housing in any other suburban market across the country, we're down on a relative basis.
Well, I think too, what's really helped us, I mean, we got hit harder here in New York City by COVID than pretty much any other place in the country, is having that inventory was actually very useful, because when the gates fly open and people want to buy, it's better to have a decent amount of inventory, which we had, and that kept prices from getting out of control, which meant when rates did go up, they didn't really have to decline because they hadn't really increased that much.
Sure.
There was an interesting report. New York State Comptroller just issued a report last week saying that housing costs in the New York City area, surrounding suburbs too, are up 68% over the last decade, more than any other major metropolitan area. I might say it's just how great this area is. But look, one of the things that makes this area, not just New York City, but where I live in Long Island and Westchester, expensive too is property taxes. Property taxes are crazy in a lot of places, but in New York City, not so much because they have income tax. But in the surrounding suburbs, I mean, I think Westchester is one of the top 2 or 3. Nassau County, where I live, is right in there. It's rough, right?
Yeah, no, for sure, absolutely. In the burbs, for sure. City, it's a little bit different, but then we get to pay income tax, so they get their piece of flesh one way or the other.
And common charges, because we especially in Manhattan, the overwhelming majority of owned homes are apartments, co-ops, and condos. And common charges are brutal, right?
It's brutal, absolutely. And when you look at new developments now, the real estate tax assessments coming in, the combination of the carry to support the labor and what have you, I mean, it's through the roof. I mean, it's unbelievable.
Well, and we're getting we're getting the initial assessment roll, I think today.
Is that today? That usually
it's
comes
usually
out
January 15th.
Yeah, right around now.
So we'll know the proposed assessments for the upcoming year in New York City, and we'll talk about that probably next week. So it's tough because the things that cost the most, like we said with core CPI, take the longest to come down, right?
100%, absolutely.
Speaking of CPI, now we're going to answer that question from before.
Yeah, what is the difference between deflation and disinflation?
All right, well, deflation is easy, right? You deflate a tire, you let air out. Deflation means prices are going down. And so the opposite really of inflation is deflation, right?
Yep.
Price going up. So, but that's not what we're seeing right now, as you said. We're
No.
seeing disinflation, which means
When you see disinflation, that means the rate of growth is actually what is declining. It's not that prices are coming down, which is why I think the consumer sentiment in the U.S. is negative, even though the inflationary environment may have improved, because consumers are going out there and saying everything is still really expensive and it's still going up, and I still feel like my wallet is being stretched, even though the economist might say, well, it's now at 3.4%, it was at 4.3%. It doesn't matter. It's up 7.7%.
Would I ever say that, Hannah?
Ask me later.
It's funny because I have these yearly arguments with my parents and now my mom about the Social Security. Like last year was like 9%. Like this year it seems like nothing.
Yeah.
And by the way, that is a concern because baby boomers and older people have been really carrying spending in the economy. And
they're on fixed incomes.
And a lot of them are on fixed incomes. So that is a problem. So there's your real economics textbook lesson. So what we're going through now is disinflation, which is a price growth is slowing, but prices are still going up, except for eggs.
Except for eggs.
Go out and
Very important.
Go out and get your eggs on because who knows, they may be going up next month. So.
Right.
All right, we got one more. I just thought this was funny as a boss.
Yes. It turns out, for a new survey, information came out, bosses want to work from home more than employees, which I don't know. I mean, did you assume that? Like I was a little shocked by this.
I'm shocked so many bosses admitted it. I more than anything,
68%.
I think the thing about being a boss is that a lot of what you do, you're going to do, whether you're in the office, working remotely, on vacation, or whatever. There's a certain level of work that is for you, and you have to get it done. I think that that may have played a part in it. I don't know. How do you feel about this one, Ari? It's surprising. I would say when I saw
I think it's a little surprising. I don't know. I might question the quality of that survey. We'd have to dig a little deeper.
They surveyed 3,000 people, I think.
Yeah,
right?
3,000 people according
That's a decent
to
sample size.
software firm Checker, which I honestly
never heard of them.
But CNBC covered it, so it must be something.
Then it must be real, yes.
Because Gen Zers get this reputation that they don't want to come into the office.
Not
and they don't.
me.
Of course not.
I
You
love
love
being
it.
here.
You're here, before they open up the joint because you're that into it.
I'm
right?
the one that turns the lights on.
Actually, that's me. But I'm an old guy, like early in, then go home for my nap kind of thing. But it shows you that a lot of what we think we know
is not always accurate. Yeah, for sure.
we don't always know. So we're just thinking it's a little early, especially on a day when it was snowing before. But what are you thinking about the housing market now and then into the spring season? Because that I always say we don't know what kind of market we have until spring.
We don't know. I mean, it's interesting. We were talking about it this morning as a team. I mean, sometimes you start to get a feel after MLK Day, but it feels like the on-step or the onslaught of kind of initial inventory is very slow this year. So we'll see, how that plays out. I think between election year uncertainty and sort of, Fed funds interest rate uncertainty, I think a lot of people are in a little bit of an analysis paralysis mode right now. But to your point, I don't think we'll really know until we get into the core of the spring. Yeah.
Well, I think elections are always talked. We talked about this last week too. People always want to know what the impact is. I always want to remind people they don't happen in a vacuum.
No.
You have elections. We saw during COVID. We've had elections in the wake of Lehman Brothers.
Sure.
Tech bubble bursting, and recessions. So I mean, if it shapes up the way we think, we know. We've seen what both the leading candidates do as president. So
Sure.
You have an idea. I still would like someone to find me somebody who didn't go forward with a purchase because of the outcome of an election. Maybe it's happened. I don't know.
No, I don't think people don't go forward with a purchase, but I think they may kind of hesitate or waffle a little bit in terms of making longer-term decisions.
If it makes them feel better, I guess.
Yeah,
But
I think there's a little bit of that.
The Fed thing, too, you remember they had a plan for one more rate hike in 23 that didn't happen. So we can't set this in stone. And one last thing, and I'm sure you have to remind your clients of this from time to time, what the Fed does with this overnight rate that it doesn't really use anymore has no direct correlation to 30-year mortgages.
We talk about this all the time. The 10-year yield and the 30-year fixed move in relative parallel. The Fed funds rate sets kind of interest rate climate, but they don't set interest rates from a mortgage perspective.
Yeah, and we talked about it so much that I learned in economics school, business school, but economics, is not true anymore. We talk about government debt, right? And then we always said, well, if the government runs up massive debt, which it only seems to do these last decade or so, then that's going to hurt everybody because rates are going to go up because that's the cost of borrowing money.
Sure.
That turned out to be completely false in the 90s and every decade since. Also, this idea of the Phillips curve, that if unemployment got low enough, you'd have to have inflation.
Sure.
And that wasn't true either. I think the problem with inflation, again, is people don't understand what the root causes are. It's either a supply issue, a demand issue, or both. Mm-hmm. And when you increase the money supply by 40%, like we did after COVID, and then you can't get any goods because of COVID, you get it from both sides. But either of those alone would have led to pretty high inflation.
And also people forget, so the stimulus money that came into the economy during that supply chain constraint during COVID came at the end of a 10-year cycle post-Lehman, having already put stimulus money into the economy to get us out of the recession last time around. So it's like we kept layering on layers of the onion, which is why, by the way, it becomes a lot harder to bring it down because it was systematically built up over a almost 10 to 15-year period.
Well, and the tools don't work the same way because we used to have what we called a scarce reserve policy with banks. Keep as much on deposit with the Fed as I have to cover my deposits. Now it's an abundant reserve policy. So, the banks don't really even trade Fed funds, last I heard, because the Fed now is actually paying more in interest to the banks that have money in deposit with them than they're earning from their treasuries. Mm-hmm. Sounds a lot like Silicon Valley Bank, doesn't it?
That's a little
That's
scary.
Another thing we forget. We got through a bank crisis last year.
The biggest bank crisis in U.S. history.
Biggest failures, yeah.
Failures, and we've forgotten.
Well, when you can take billions of dollars out in a couple hours without actually having to wait online,
you just press buttons and you pull your money out.
That can happen very quickly. Well,
Yes.
we ran a little bit over our 30-minute threshold, but I could talk to Ari for another
Yeah, it was well
3
worth it.
hours,
We can get
right?
real nerdy here if you
Yeah.
want.
I think
We would love that.
Well, you know what? Send your comments, and I'm curious. A lot of people say if it goes over a certain point, they're afraid to start the podcast. I'm just curious.
Who?
Maybe we do a somewhat scientific analysis of this, and people let us know. But I want to thank Ari for coming. It's
Thanks for
great,
having me.
and,
It's
Yes,
great.
and we
thank
hope
you.
to have you
Thank you.
on from time to time because you bring a great insight.
Thank you.
And you speak economics good, unlike me.
Well,
And you do a really good job of breaking it down.
I've been doing this for a long time. You try to blend like the data and the personal side. Not always easy, but that's the goal.
Well, being an economist is a little like being a real estate broker. You take all the factors into account to come up with a value or a direction of things, and that's really what I do. And regardless of what was said before, I'm not a math whiz. The computers do the math. I'm good at explaining things as long as Hannah edits what I write, and
yes.
then I sound like I actually know what I'm talking about. But want to thank Lena and Ray for their help behind the scenes, and Hannah as always, and to the great Ari Harkov. Hope to see
you,
you
Greg.
soon, buddy.
Great to see you.
And thank you to everybody for listening and supporting us.
Yep.
It's been great, and it's always fun crossing the line with you.
And be sure to like and subscribe to the More Network. for
And
a
again,
ton more, just
great-
like this one.
Great reminder, all the podcasts on there, whether it's mine, Vince's, Candace and Melissa's, Danny's, Bess's, they're all different. None of them are, the typical real estate shows you see
Yeah,
on.
there's a wide
on-
range.
We're talking about economic issues. There's issues about wealth, and Steve Kligerman's one about development.
Right.
Check them all out. They may not all be as great as mine, but they're all great. So love
No
them all.
comment.
Thanks again, everybody, and we'll see you next week, or you'll hear us next week, one of the two. Thanks again.